Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at Dollar General. This is a stock that recently cut its guidance and has been punished for it. They've been on a downtrend basically since early November of last year, and they are hitting a decent price as of this last week. There was a request to take a look at it, and as I've looked at it, pleasantly surprised. So let's get into it here. We see that the buy price that I have set is around $157.50. I mean, it's trading for $163.50, so it's a bit above that, but it's in the range. Fair value, $185.80, and sell would be $205. So it had been trading pretty high for a while, up until that guidance cut on the 1st, and it saw a steep drop. That drop brought it right to where I'd personally like to see the stock. And looking at what they said about the guidance cut, it's not even that bad. The market likes to overreact to misses and cuts, but we see that they've usually had over 10% growth, nearly 11% year over year. These last 2 years had been almost 6, and they just cut their guidance and said they're only growing 5 this year. So it's almost in line with what we've been seeing for the last 2 years. Slightly lower. Growth is good. We do see that analysts are expecting a decline in the earnings per share. So we'll see how all that shakes up. I honestly don't know if I trust that number. I feel like they're going to come in a little bit higher than they came in last year, but this is what analyst projections are for the stock. Their cost of goods has risen at the same pace, if not faster, than their revenue, which that's not very good. Their gross profit is up from 2019. It's kind of traded down since 2020. Expenses as a portion of their revenue is down year over year, just slightly up in these last 2 years. So that's a trend that's changing that we don't really want to see change. Net profit, nice growth since 2019, but a decline over the past 2 years, which leads to a decline in the net profit percentage. Their margins surprised me, 6%. So they just have retail margins. I thought that it might be a bit worse since they're selling stuff for $1.25, but they're not awful. Again and again, we see 3-year, pretty good. 2-year, changing trend, not so good. The share count, they're great about buying back their shares, somewhere between 4 and 5% every single year. Shareholders' equity has been declining, so that tells me that their liabilities are increasing faster than their assets, which we can confirm down here. Their cash flow is declining. This is probably one of the most important factors that I look at for a company. I don't like that. They had awful cash flow this last year. Their free cash flow yield, 1% is not good. If they could get back up to the 5s and 8s, that'd be good. So as of the end of last year, we saw 1.1% cash flow yield, 4.3% earnings yield. So the earnings are pretty good, and they drive quite a bit of the value. Aside from that, it's the dividend. Even though they only pay out less than 1%, they're growing it incredibly fast, almost 20% year over year. Assets are growing, but the liabilities are growing faster. The tangible assets are what is really on the decline. So we end up with a very small tangible book value that is trending down. Debt to equity is incredibly high. I don't like anything that's over a 1. The book value per share is 2 cents. The cash per share is $1.69. So this balance sheet's not in great shape. And we can see that down here where it's been trending down for the most part year over year. Last year, I would have put the balance sheet at about $74 for a fair value. The share price has been growing. It's compounding almost 17.5% year over year. So it's got great growth, almost twice what the general market gets. This last year, these last 2 years, it has slowed down a bit. It's 7.26%. ROE, 43. That is something that's been climbing, and that's very nice. But it's likely climbing because the equity is declining. And then the PE, this stock typically trades in the 20s. It's like low 20s. Right now it's at a PE of 16. So there's some upside on the earnings front. But I'm coming up with, for the end of last year, fair value of $175. Going forward, $195. Which, for a value investor, that'd give us a buy somewhere between 150 and 166. And a sell somewhere between, say, 94 and 216. At first, I thought, you know what? This is pretty good. It's getting into fair value range. Might be something to buy. But that balance sheet, those liabilities are growing very fast. The biggest red flag I see here is this debt to equity. So unless they can turn this around, instead of seeing it climb year over year, I'm not sure that I'd consider it a quality company for me to be investing in. I give it a hold because by Benjamin Graham's metrics, 4.3, that's decent. We're looking for something above 4% earnings yield. And then for Peter Lynch, we're getting his formula, we're getting a 1.68. So it's slightly undervalued. Personally, how I look at it, this is the weighting that I like to give stocks, and my formulas are a little different in there. Rather than using what the market tends to like, it's what I'm looking for. And I'm coming up with 117 for the fair value at the end of last year and 160 for the fair value as of the guidance, the expectations for this year. So it's approaching a range. If you are a dividend growth investor, this is probably a stock on your radar. It's come across my radar in the past when I was really into dividend stocks. And if you're an earnings investor, it had experienced decent growth for a while. And the stock was mostly trading in correlation to that metric. If you like cash flows, this probably isn't a stock for you to look at. And balance sheet, I'd say about the same. So I'm going to have to give it a hold. It's approaching buy range, but certain metrics that I look for a quality company, it just doesn't hit. The fact that we're losing shareholder equity and the debt is so high, outpacing the growth in assets. It's not really a stock that I could get behind. Hopefully you guys enjoyed this video. Like if you learned anything. Comment if you disagree. Or if there's any other stocks that you'd like me to take a look at. And I'll definitely look them over and let you guys know what I think about them. Maybe in the future, I'll even look over whole portfolios if that's what you guys want. So thank you for watching, and I'll catch you next time.